Welcome to our lecture on financial management. Today, we will talk about the balance sheet, one of the most important financial statements for companies. Let's begin. A balance sheet is a snapshot of a company's financial position at a specific point in time, governed by the fundamental accounting equation: assets equals liabilities plus shareholders' equity. This equation must always balance, reflecting that all resources owned by the company are financed either by borrowing or by owners' contributions. Let's break it down. Assets are economic resources controlled by the firm, categorized as either current or non-current. Current assets are expected to be converted to cash or used up within 1 year. These include cash and cash equivalents, accounts receivable, inventory, marketable securities, and prepaid expenses. For example, a company might have $20 million in cash as a current asset. Non-current assets are used over a longer period, such as property, plant, and equipment, intangible assets like patents, and long-term investments. Consider a company with an $80 million factory, which is a non-current asset, and $20 million in cash, a current asset. These are distinct in their liquidity. Liabilities represent claims of creditors, what the company owes to others. They are also divided into current and long-term categories. Current liabilities are due within 1 year, including accounts payable, accrued expenses, and the current portion of long-term debt. Long-term liabilities are due beyond 1 year, such as long-term loans, bonds payable, and lease obligations. For instance, a company with $500 million in long-term bonds might list $100 million as a current liability if it's due next year, with the remaining $400 million as long-term. Shareholders' equity represents the owner's residual interest in the company after all debts are paid. It includes common stock, retained earnings, and treasury stock. Retained earnings are accumulated profits not distributed as dividends. If a company earned $30 million and distributed $10 million in dividends, retained earnings would be $20 million. Let's look at a simplified balance sheet for ABC Manufacturing Co. As of December 31st, 2024, their total assets are $2.65 million. Their total liabilities are $1.25 million, and total equity is $1.4 million. This confirms the accounting equation. $2.65 million equals $1.25 million plus $1.4 million. Analyzing a balance sheet provides insights into financial health. Liquidity, for example, assesses if a company can meet short-term obligations, often measured by the current ratio. Leverage indicates how much debt is used to finance assets, typically measured by the debt-to-equity ratio. Asset efficiency shows how effectively assets generate sales. For example, a current ratio of 2.6 indicates strong liquidity, while a debt-to-equity ratio of 0.89 suggests moderate leverage. The balance sheet also integrates with other financial statements. Profits from the income statement increase retained earnings on the balance sheet. The cash flow statement explains changes in cash between two balance sheet dates, and the statement of shareholders' equity details how equity accounts change. However, balance sheets have limitations. Assets are recorded at historical cost, not market value, and intangible assets like brand value may be underrepresented. It's also a point-in-time snapshot, not reflecting trends. Despite these, analyzing assets, liabilities, and equity gives a comprehensive financial picture. When studied alongside income and cash flow statements, the balance sheet is an indispensable tool for assessing a company's financial health, liquidity, and stability. Thank you for watching our lecture on financial management focusing on the balance sheet. See you at the next lecture.